Hello, everyone. My name is Mayowa Akinbote. I'm a PhD student at London Metropolitan University, and my supervisors are Dr. Limela Lee and Dr. Lan Jigan. I'm here to present to you financial market weak form efficient during uncertainty events. This study look at uncertainty events in form of global financial crisis events and Euro debt crisis event. Also, this study also looked at the Brexit and COVID-19, although Brexit and COVID-19 was not instigated by financial crisis. Efficient market hypothesis. Weak form efficient market hypothesis is one of the three categories under which efficient market hypothesis standing. Efficient market hypothesis simply means the market where all the participants, investors, fund managers are competing in order to make profit or to make return on asset prices. Farmer 1995 described the classification of efficient market hypothesis as weak form efficient market, semi-strong efficient market, and strong form efficient market. Efficient market hypothesis itself is standing on some assumptions that establish the hypothesis. One of the assumptions is that the market entry and exit of the market by all investors is free. Also, there is none of the investors that is dominant in the market. That means no monopoly of the market. Another assumption that efficient market hypothesis is also standing on is that the information in the market is freely available to all the participants or all the investors. That means there's no one having advantage of information. It also assumes that all the transaction costs and taxes are eliminated in such a way that it cannot influence the asset price. As a result of this, efficient market hypothesis believes that the price of the asset fully reflects all the available information in the market. As a result, no individual investors or fund managers can have extra or abnormal returns as a result of having additional information. So coming down to weak form market efficiency. The extraction of assumption from efficient market hypothesis that weak form market efficient is standing on is that it believes that the previous prices of asset, that is, historical prices of asset, cannot be used to forecast the future asset price. Invariably, what it means is that yesterday price of stock, for example, or last week or last month or possibly last year price of stock cannot be used to forecast next week, 1 month, or future price of the asset. Another assumption that weak form efficient market efficient is standing on is that prices reflect all information in the market. As a result, there cannot be any bubbling. Volatility is not expected to be in the stock prices because no information will trigger price movement. If these two assumptions of weak form market efficiency are true, in that situation, there's limit to what financial analysts can do to make abnormal profit or return from the market, because everybody have the same level of information and no one can use previous activities of the shares to forecast the future price. That brings me to the research objectives. This study investigates the mean return of the assets during the uncertain period. Also, the normality distribution of the asset, which means if the return of the asset is not normally distributed, it means there's random walk. That means the asset previous prices cannot be used to forecast the future prices. Also, weak form efficient hypothesis of the stock, the bonds, and exchange rate of daily return. We want to know if the previous or historical value of the asset can also be used to forecast the future price, especially during global financial crisis and debt crisis, also during Brexit and COVID-19. This brings me to the hypothesis. The hypothesis of the study is that the asset returns follow random walk. And the second known hypothesis is that financial market during this period of financial crisis, Brexit, and COVID-19 follows weak form efficient market. And lastly, want to show that there's no difference in return of assets during financial crisis and Brexit and COVID-19. Research method. The method that is used in this research is quantitative, looking at the developed economies, financial market, and we use descriptive statistic, which is Squidness, Coffees, and Jacqui-Berra test. This is used to evaluate the normality distribution and randomness of the return series. We also use the unit rule test of Dickey-Fuller, ADF, PPP, and KPSS. And lastly, standard GASH 11 were used to test for volatility clustering. The result. The mean results shows the evidence that there are mixed results of the return series. So From the normality test, we look at the mean, and the mean return shows that during financial crisis, that is global financial crisis and euro debt crisis, the mean return of the sampled assets in the financial market of developed economies show low daily expected assets return, of course, with low risk as well, in comparison to Brexit and COVID-19 events. That is, Brexit and COVID-19 event still have some sort of good return, expected good assets return with reasonable high risk in level of that return compared to the low returns on asset that is witnessed during financial crisis. The second test of normality distribution rejected the null hypothesis. That means the assets return series did not follow normal distribution. Therefore, the assets return do not follow random walk. The other test is the unit rule test, which rejects weak form efficiency. And GASH111 model also exhibit high volatility clustering. These results support the common notion that the financial market in the developed economies are not efficient, especially during the financial crisis and Brexit, along with COVID-19 period. And to some degrees, this can also explain the less optimal allocation of portfolio in this market during the period. There are implications to this result. One of the implications of rejecting weak form efficient for investors is that they can opt a fair return. They can adopt a fair return for, they cannot adopt a fair return for risk strategy by holding well on a diversified portfolio while investing in financial market. So it means that a hardworking investor can make abnormal return from the market. What it also means is that the previous year's price of the asset can be used to forecast the future price. So, well-researched financial analysts can do more in the financial market space and can make abnormal return. And it also shows that information in the market is not fully reflected in the asset price. And lastly, that some of the assets in the financial market during this period are undervalued assets, of course, and of which, if investors manage to get on this asset via its research or financial analyst that is hardworking, can get this undervalued asset, which will quickly result in high return. However, there are other assets in the financial market during this period that also offer high or overvalue, which means any investors that didn't do the research properly could end up buying assets that are overvalued, and as a result, they will have negative or low returns from the asset. These are the implications of the study. And I'm happy that you're listening to me, and I'm glad, and I hope that you have questions, and I hope that I will be able to answer your questions to your satisfaction. And thank you very much for listening to me and paying attention to me. Thank you so much. Bye.